My name is Allen Featherstone. I'm a professor here in the Department of Agricultural Economics, and we'll turn it over to Robin and she can introduce herself.
And I'm Robin Reid, and I am an extension farm economist here in the department, focusing on land values and a number of different issues, but that'll be the topic I'm covering today. Alan, we're going to let you get started and we'll kind of tag team back and forth here throughout the presentation.
That would be good. And one other fun fact, both Robin and I are from Wisconsin. And so we're both Kansas imports from the state of Wisconsin. What we're going to do today is we're going to kind of go back and forth between Robin and myself in terms of, I'm going to set the stage a little bit. And in some respects, I think we're in the paradigm shift. And certainly this first poll that we had you look at certainly provides input with regards to where we are prices. Then we're going to talk a little bit about USDA numbers from last August 2020 with regards to cash rents and land values. Then we're going to, and Robin will cover this, she will jump into some land value sales data. One of the things that will be unique here is we have data from the first quarter. And so we have data through March of this year. And then we'll take a little bit of look at what the future is moving ahead. And then we will provide some concluding thoughts. The next four graphs here, I think, just indicates where we are from a paradigm shift in terms of moving over the last essentially year, 2 years, 3 years. In terms of what we've done here is we have the Salina cash wheat price for delivery in Salina. And we have a weekly average here since the beginning of 2018, all the way through last Friday with regards to that. One of the things you can see certainly is the run up in wheat price. In some respects, wheat price ran up a little bit slower and has not run up near as much as some of the other commodities on a percentage basis. But certainly we do see a run up in terms of at the close of last Friday, wheat was over $7. And just a year ago in some of the low spots with regards to that, essentially where we're down in the less than $4 and or very close to $4 in the COVID crisis. If we look at the corn price, you can see that that has run up in terms of, if you look at last year, 2020, again, you see some prices, cash prices below $3. And again, last Friday in Salina, it closed over $7. Same type of thing with regards to sorghum price. In terms of in 2020, if you look at week 10 or 11 in there, sorghum was basically about $3. Essentially, it ran up very aggressively through kind of February this year, up to $7. Then it actually backed off a little bit, but then it's run up here the last couple of weeks. And so in terms of looking at this, soybean price, we take a look at that. Again, you see soybean price less than $8 in 2020. Towards the second half of the year, it started climbing, and the weekly average was above $15 at the end of 2021. And we've actually had some additional increase there since last Friday. In terms of, if you look at the markets the last couple of weeks, you can see a run up. In terms of looking at this, and again, this kind of gives what the cash bid is as of yesterday in terms of for wheat, corn, sorghum, and soybeans. Again, this is in Salina, and obviously in different parts of the state or different parts of the country, it would be a little bit different just due to basis. But again, you're seeing a 7 in front of wheat, corn, and sorghum, and you're seeing a 16 in front of the soybean price. The other thing I think that's important, and in some respects this kind of gets at the poll that you filled out, is the forward bid in terms of wheat is 722. Corn, and again, these are of yesterday, 596. sorghum 676, and soybeans at 1380. And so you can see virtually no difference there on the wheat price in terms of the forward bid, cash bid is running right together. Quite a bit of difference there with regards to corn, sorghum, and soybeans. And as we get closer to harvest in the corn, sorghum, and soybeans prices, certainly the cash bid and the forward bid will need to begin to move together. But at this point, there is some premium there. In terms of, I've been kind of constructing this chart here for a couple weeks, and we've seen a dramatic increase in the forward bids recently. In terms of, we've probably seen over the last 2-3 months a movement of $1 in corn. And then certainly we've seen an increase in wheat and continued increase with regards to soybeans. A month or two ago, that forward bid would have been 11 something for soybeans, where now it's approaching 14. And so this kind of summarizes in terms of, I went back and just looked at the lows with regards to COVID. Wheat, again, as I indicated, is lagged. We're only 70% more than we were the low of COVID last year. Corn prices have more than doubled. Essentially, we're 155% of where we were from the COVID lows. Sorghum prices are about doubled, 115%. And then soybean prices have essentially doubled. And so certainly we've been in a very strong paradigm shift. And the question is how long is this going to last? To give you a little bit of an indication in terms of, I pulled some CME prices here for 4 years out for corn and soybeans and 3 years out on wheat, just to kind of look at what they're bidding into the futures market for harvest prices. And so for corn, I looked at November 2021. It's right at 6 right now. Or December 2022, 509, essentially 2023, 451, and then 2024, 432. And so you do see that right now the market is expecting that as we move into harvest, that over the next 4 years, you'll see a little bit of decrease. Beans, basically, the fall crop in November is 1450, 1268 for 2022, 1150 for 2023, and 1132 for 2024. And so again, you see the same type of pattern. If you look at wheat, wheat's a little bit different. Essentially, harvest price for the Kansas City board in terms of July contract is 697, 718 for 2022, and then 632 for 2023. And so actually the wheat is a little bit different than both corn and beans, where they're actually seeing a little bit more premium as we move into the next year. The last thing I want to do is just give you an indication of where we are from a yield and revenue protection, basically the CRC, your revenue crop insurance prices. Essentially for 2021, for soybeans, you're looking at 1187, 490 for wheat, 458 for corn, and 440 for sorghum. Sorghum is priced off the corn contract, and certainly there's some arguments of whether or not that's a good thing or not. With regards to wheat, that was set way back in by September 15th of last year, and so wheat did not participate in any of the run-up. And in the parentheses there basically is kind of the current cash bid. And so in some respects, you see that corn is about $1.40 above what the price was that in February when that price was set. Sorghum 676 and soybeans are 1380. And so again, this gives you just a little bit of an indication of the run-up we've seen over those previous months. And as we begin to think about rental rates and land values, certainly the numerator of that equation used to price that, the return to farming is very important. And so let's jump in and we'll turn it over to Robin, and she will take a look at the rental rates.
All right, as we get started, we have another poll question for you. We're trying to get you a little more interactive in this presentation here. So go ahead and answer that as we're transitioning. How have cash rental rates for farm ground changed in your area compared to 2020? Give you a second to complete that. A little over half that have responded. Give you just another second here. All right, and it looks like most of you said same as last year, with a small amount saying 0 to 5% higher, 5 to 10% higher, and a few saying 15% higher. So if you want to go ahead and take that down, Rich, we'll jump into here. So as Alan talked about, we're in a different environment right now. We have these higher grain prices. Logically, we are going to see more competition for new rental rates or new ground that's on the market. So we will, I would say, arguably see higher rental rates this year. Somebody's moving that on me here. There we go. Sorry about that. So just to kind of show you what's been going on throughout the last 10 years here. So rental rates in my mind are sticky, meaning as we have changes in our commodity prices and our net farm income levels, you would expect them to react, but they actually move fairly slow. So back when we had high grain prices, when we saw $7 corn, we had this era of about 2010 to 2014 where we had really good profitability, really good grain prices. And you can see really at the state level, our non-irrigated ground went from just over $40 an acre to now about $55 an acre. So we saw a run up, but not very much. And then arguably ever since we've been fairly flat. So as we went back to $3, $4 corn, we did not see a decrease in that cash rental rate. And kind of same with our pasture ground, we went from about 18 an acre to 20 at the state level and have been fairly flat at that amount ever since. So with the new commodity prices that we're seeing now, I would expect to see a jump in this value, but not very high. And that's because we have a lot of rental rates that are negotiated longer term, or when you're even negotiating a new rental rate, you're looking at the long-term level that you can pay for that and not necessarily what this year's going to be unless you negotiate every year. So unfortunately, we don't have a whole lot of information on rental rates other than what the National Ag Statistics Service puts out. So we do get one number per county for irrigated, non-irrigated, and pasture each year. And those come out in August, as Alan mentioned. So here I have 2020 one rate for the county. And I know this is one of the most questions that our county offices get on the rental rate and what the going value would be. And I would just emphasize that these are averages for the county, and there's a lot of variation around that number. So depending on the characteristics of the ground and who's bidding on it, you might be quite a bit above that. Now, pasture, we have a couple counties here that don't show up, and I will mention those are because not enough surveys were returned to report a value. So it is important to fill out those surveys when they do come to you. And then very limited for irrigation numbers across the state because we just don't have that much irrigation in some areas. And again, the survey data is quite spotty. So these maps are available on agmanager.info under the land and leasing section, or they're available from the National Ag Statistics Service. And again, we'll get the 2021 numbers in August. Now, one thing I want to look at a little here is this is probably something a lot of you have not seen or haven't looked at lately, and this is the rent to value ratio. So how much is that ground worth versus how much can you cash rent it for? So these are both values at the state level that come from National Ag Statistics Service. So just an example here, if you purchase the ground for $2,000 and it's non-irrigated, 2.8% would tell you that you should cash rent it for 56. if this was to hold true for that piece of ground. So these have really came down since we had the run up in land values from 2010 to 2014, and they've remained quite low. And again, that's because those cash rental rates are quite sticky, even though the land market can be moving quite quickly. And it's just been staying down at this level due to a number of factors, with our interest rates, with some more interest in non-ag investment in our ground across Kansas. And we're going to talk a little bit more about that later when we get into land values. But overall, we're seeing fairly low rent to value ratios in all three of our categories here across Kansas. So to kick off the land rental section, I'm going to turn it, or sorry, the land value section, I'm going to turn it back to Alan. I think we have another poll question here. What direction are the agricultural land values trending in your area?
And we'll come back to the cash to rent aspects at the end, but kind of looking at here, basically, there is some lower in terms of about lower, and then all the way up to 15%. And so,
do you want to share those results, Rich? There we go. Thank
that'd be great. And so you see that essentially 41% indicated that they're in the 0 to 5% higher. There was about 5% that suggested 0 to 5% lower, 11% the same. And then we see some areas within the state where they're 5 to 10% higher, 20% there, 10 to 15% higher, 13% responded there, and 15% higher. A few more indicated that. And so looking at this, one of the things that we're going to do, and these are using the USDA NASS numbers that are the same source where the cash rental information that Robin has. But what we ended up doing is just taking a look at these from 1950 to give an aspect of where land values are going. And certainly this graph here, I think has people worried about some of the legislation going on in Congress with regards to stepped up basis. Certainly you can see just the big run up there with regards to land values in terms of 1994, 1995, it was about $500 per acre. Then in about 2008, we hit $1,000 per acre. 2014 kind of went past the $1,500. We're up at 2,000, and we've seen a little bit of leveling off from about 2015 forward, and a slight decline, although we did have a jump in 2019 and 2020. But if you look at this in terms of land, essentially is about a 4.9% return year in, year out. With regards to that annual appreciation since 1950. And so essentially we're looking right at about a 5% return. If you take the rent to value ratios there, add maybe the 3% for irrigated, that would get you up about an 8% return. If you would add the number for the non-irrigated at about 2.8, you add 2.8 plus 5, that basically would end up giving you about a 7.8% return year in, year out. And then on the pasture, it would be about a 6.5% return. And so certainly looking at that, land is a good investment. Some people will argue with regards to whether or not land is a good inflation hedge. And so these are the numbers basically just adjusted for inflation over the period. In terms of looking at this, in terms of several of us remember, for example, the 1970s and 1980s with the run-up. Essentially, if you would look at the run-up that occurred there, essentially the peak was 1980, 1981 at a little bit more than $1,500 per acre in constant 2020 dollars. And so you can see that the prices where we are from 2015, 14, 16, in there, we were over $2,000. And so in some respects, we're at inflation adjusted land values of about 33% more than where we were in the 1970, 1980s crisis. In terms of looking at this, essentially land has appreciated at about 1.75% greater than inflation. And so as you look about this, land is not a bad inflation hedge. Essentially, normally it returns about 1.75% above the inflation rate. And if you took a look at the news with regards to where we are on inflation, the CPI for the most recent month came out at an annual rate of about 4%. And so if we do get into an inflation type scenario, over the long term, land is a pretty good investment with regards to that. I think it is important to realize that there is a distribution of land price changes, and normally it is positive, but certainly we do have some aspects there with regards to up and down years. You can see that the chance of land kind of being in this more than negative 20% hasn't happened, more than negative 15%, about a 1% chance. And so if you look at that, the normal case is kind of land is going to appreciate on a nominal basis, kind of around that 5%, kind of in that bin there. If you look at the inflation adjusted numbers, you can see that those are skewed a little bit more negative in terms of there have been times where essentially in inflation adjusted land value, we had a decrease of more than 20%. But I think the important thing is that while there is some distribution around there, around land value changes, generally they tend to be positive. There is some possibility that they do end up dropping, but it is a fairly low probability that that land decreases. And so looking at that number that land values could decrease, you're probably somewhere in 1 in 5 years that you would see a nominal decrease in land values using USDA numbers for Kansas as a whole. And you'll see a little bit more, probably 1 in 3 years in terms of land will not beat inflation. Conversely, if you want to look at it from a optimistic perspective, 1 in 3 years, it will end up looking at beating inflation. In 2020, the most recent year, land values fell by 3.1%. Inflation adjusted land values fell by 4.2%. And then you have the numbers there. But again, in terms of land values, basically 1 in 5 years will decrease. And that's what we've seen since 1950, roughly 70 years of history. Again, a little bit more than 1 in 3, 36% of the time they will decrease. And so basically that means 2 in 3 years they'll increase. Most of the time, you're not going to see big swings. In terms of 73% of the time, nominal values are between the negative 5 and 10%. 81% of the time, inflation level or land values adjusted for inflation are between that negative 5 and 10%. And so overall, you'll end up seeing land being a pretty good investment over time. In terms of looking at this, a couple things, we've just kind of graphed out these nominal numbers for cropland and average pasture land for the U.S. as a whole, just to give a bit of an indication. But really nationally, what's going on, Kansas hasn't been too far from the nation. In terms of after 2014, the U.S. Cropland values have been relatively flat. We've probably seen a little bit more appreciation after 2014 in pasture land values. in terms of they've jumped up at about $100 per acre, or about 3-4% on an annual basis since that. And so certainly that gives a little bit of a picture. And then the next 3 slides, and you should have a copy of these slides, it just kind of gives kind of what happened from 2019 to 2020 on a state-by-state basis. And so if you kind of want to look at, well, where are you compared to everybody else, it kind of has the price per acre in different shaded regions. And then it has kind of the current value and the change from 2019. And so we have this for all of farm real estate. Then we have this from a cropland perspective. Cropland dropped by 3.7%, so a little bit more than all of land as a whole. And cropland, essentially, you're looking at about $2,000 per acre in Kansas on a statewide basis. And again, these are going to vary much by region. And then if you look at pasture land, essentially those numbers are there. And again, in 2020, from 2019 to 2020, pasture land did not decrease as much as agricultural land. And so with that, we're going to now turn it over to Robin, where she's going to take a look at the Kansas numbers, where we're looking at actual sales data.
All right, thank you, Alan. And this land sales book, we're in the 3rd year of. I have all 3 copies there on your screen. But just know these did hit our county extension offices this week. So I have a copy in front of me here. You can go to your county extension office and pick one of those up. There's no charge for those. And it's also available on Ag Manager. So in this book, we are taking actual sales values from the Property Valuation Department in Topeka through a partnership with the Kansas Society of Farm Managers and Rural Appraisers. So I actually do have Q1 data for 2021, which I'll be talking about today. But just to give you some context as to how I kind of clean these numbers to get to the ag value, these are only parcels that are above 70 acres. So I'm trying to really isolate that ag use. And then I eliminate any extreme outliers that I see that to me would indicate family to family sale or something for development or another purpose. So as we move forward here, hopefully. So as we look at 2021, the first thing that I've noticed in looking at our sales data over the last 2 quarters is we're seeing an increase in sales volume. So we had quite a bit of sales volume in 2015 and 2014 as we had a really hot market, real high commodity prices. And then as we had that big drop in commodity prices, we just saw less land on the market. That has picked up some in the last few years, but Q1 here, we had 130,000 acres sell already. And that is the highest quarter since 2015. So the highest amount of sales since 2015. Also, our last quarter of 2020 at 116,000 acres was the highest quarter since back to 2015. So this is an indication itself that our land market is heating up a little bit. And then if we look at actual prices at the state level, so what I did first is just look at Q1 of 2021 and compare that to last year. So we had the roller coaster of commodity prices last year. So this would have been pre-pandemic, basically. And from that level, our non-irrigated ground across the state has actually experienced a 9.4% increase comparing those 2 quarters together. Our pasture and hay ground, 9.8% increase since this time last year. And then irrigated, 29.6%, but the caveat there is we just didn't see a whole lot of irrigated sales in Q1 of last year. So this number here is misleading, and I would not say that our irrigated ground is up 30%. It just happens to be what sales occur across the state, different regions, and that can play a big role into some of these numbers. And irrigated being the less amount of ground out there, the least amount that's sold, that number can have a lot of bouncing around to it. So just to kind of illustrate that as well. So if I just compare Q1 of this year to all of 2020, so all of our sales last year, how do we compare just in this first quarter? Non-irrigated ground is again up near 10% already since what we saw last year. Pasture and hay is up about 6.3%. And here's where I have more confidence in this irrigated number. We're fairly flat at an increase of 1.4%. Now let me just focus a minute on sales volume. So our crop reporting districts, we have 9 across the state, and that's kind of the level I break it down to here. If you get the book, there are actually county level numbers. But the one thing I want to emphasize, first off, like I said, we had less sales volume as we saw a downturn in the farm economy, and then it's picking back up some. We are on track to have a fairly high volume year in 2021. But the thing I want to focus on here is just how much the Southwest region drives the state value. A lot of the volume of land that's sold is down in that Southwest region year over year, and they tend to have the lowest prices in land across the state. Conversely, our Northeast region that has some of the high 10,000 an acre prices you'll hear in Brown, Doniphan, and Atchison County make up only a small volume of the total ag land that's sold in the state, so about 5.4% over the last 6 years. So even though you'll hear prices increasing quite heavily in some of these regions, it affects the state number at different levels because of that sales volume. Now let's look at these state numbers. So the top one here would be our irrigated ground, blue being non-irrigated and green being our pasture and hay ground. So in Q1, again, that change was about 9.7% on non-irrigated ground. We saw the peak in 2015 and it since came down to right around 2,000 an acre and have remained fairly steady ever since. Now, one of the questions that I pose is how much of an increase do we need to see in this year to get back up to our peak, or how many years will it take to recover what we lost over the last 5 years? So to calculate that percent change to get back to 24.40 an acre, that's a 20% increase over the value that it was in 2020. So do I see non-irrigated ground recovering in 1 year? Probably not, but we are well on our way at the state level, and local markets, as I'll show, some of them are even recovered to that level. With pasture and hay ground, we are going to need a 14% increase to get this value back up to what it was in 2015. And then irrigated ground, I believe it's about an 11% increase. We just didn't see the drop that we did in the other categories. So to look at this regionally, the state levels kind of mask a lot of variation that's going on across our state. So here are the 3 crop reporting districts for Western Kansas. And in all of them, you can see that drop that happened from 2015 to 2017, remaining flat ever since. Now in Q1, Northwest has actually lost some value. So some of you that responded from the poll, in some of your local markets, you might not see an increase yet. But some of our other ones, here in West Central, seeing almost a 14% increase already in the land value sales in that region. So it is highly variable in our different regions of the state. But overall, I would expect even in this Northwest region, we're going to end the year positive just because of the commodity prices that we're seeing now. When we look at the Central region, a lot more variation here. North Central is a region that has seen some really decreasing land values throughout this downturn, but it's quite amazing how quickly Q1 has recovered here in 2021. So comparatively they're back to the value that they had in 2017. The rest of the regions, I would say, is just bouncing around a little bit, at South Central being a 13% increase and Central actually being a 6% decrease. So again, Q1, we only have 1/4 of our values for the year, and there's a lot that can still happen yet. When looking at the eastern region, these are the ones that have not decreased near as much or hardly at all since the downturn in the farm economy. So Northeast is always our highest land values by far, being about 4,500 an acre back in 2015. Q1 showing we have recovered to that level already. The East Central and Southeast, there's less ground and more pasture in these regions, so they've remained fairly steady. Now let's look at the pasture and hay ground numbers. And I would argue here there's going to be a lot of bouncing just because there's not a ton of pasture and hay ground sales in western Kansas and in the middle part of Kansas. So I think we need to get further on in the year to really know where the trend is heading. And if you think about it, we had a run up in our commodity grain prices, but for our cattle producers out there, I know with the crunch and feed prices and stuff, it's harder to bid on ground than somebody who's experiencing $7 corn and $16 beans. So I would not expect the pasture and hay ground number to be increasing as much. And I think we see that here. So some of these regions have increased in Q1, but overall we're still lower here in Central than we were back in 2015. The eastern region, so this is where a lot of our pasture and hay ground would actually be selling, and I have more comfort in these numbers than the other regions of the state. So our Northeast again is recovered from what it was in 2015, and our Flint Hills area is relatively flat. So again, these books are available at our county extension offices or on Ag Manager. Q1 is not published. That'll just be from this presentation, and hopefully I'll write a paper up on it here pretty soon. But just know, overall, I do see the market heating up. I see some higher land prices across the state, and anecdotally, have had calls from a number of you talking about land prices in your area, and I do think we're going to be seeing 10%, possibly even 15% increase in our non-irrigated crop ground this year is what I'm predicting right now. So with that, I think we have a final poll question, Rich. Thank you. And I'm going to turn it over to Alan.
Thanks, Robin. We'll let your poll answers come in. And again, I don't know how much the information that came out with regards to the CPI, with regards to inflation. I have a son that works in engineering, and they use a lot of steel. To give an indication of what they've seen is their steel prices have increased 40% since the first of the year. And again, that's not exactly, but I know there's a lot of concern with regards to input prices. Certainly fuel and natural gas have increased since the beginning of the year, and so they are there. But again, just looking at the results, 8% aren't worried about inflation at all, about 50% are somewhat worried, and then 42% are very worried. And so we're going to take a little bit of look at interest rates, inflation, and risk. And in some respects, if you look at the numerator of land values, the numerator is primarily on the earnings. The denominator basically is going to be affected by the interest rates, the inflation, and risk. And so, so far we've taken a look at that with regards to the numerator. Looks very healthy, at least for 2021 and probably into 2022 with regards to the income potential. But as with anything, there is a denominator there that becomes very important. And so looking at this, what I've done here is taken a look at weekly Treasury rates over a 10-year period. I think it's important to look at where we are and what's happened. And then we'll maybe hone a little bit more in on the last little bit by taking a look at what is more recently doing. But the purple line there is basically what the rate is on one-year money. One of the things, if you look at one-year money, we haven't seen any increase in terms of the 1-year money. And so in some respects, this is going to be more the operating line. And if we look at that, it's very close to zero. And in fact, if you look at it over the 10-year period, the purple line is about as low as it's ever been. And so in terms of short-term money, basically that's relatively cheap. In terms of next, I have the 5-year in green, the 10-year in red, and the 30-year in blue. One of the things you've seen over the last year is you've seen an increase in the 5-year, the 10-year, and the 30-year money from the weekly Treasury rates. In terms of looking at this would be more financing equipment and then some of your longer term. And so since last year, when the 30-year rates were kind of in that 1.5 rate area, they have climbed up over the 2%, and they've actually come off the last couple weeks, but again, they have increased. If you look at it over the entire 10-year time period or 11-year time period, one of the things you'll see is that still the longer term money is on the low side compared to what it's been over that. And again, these are Treasury bills with regard to that. One of the things that might be more important is what is money if it's going to be used to finance farms. What I do here is, again, the Farm Credit Corporation, the funding corporation, basically auctions money off on a regular basis and that's how the Farm Credit system is financed themselves. And again, I'm able to take a look at 1, 5, 10, and 30-year money to get a little bit of an indication of just where we are from money that's going to finance agriculture as opposed to what the government lends at from a long run perspective. One of the things you'll see here is that from a farm perspective over the last 10 years, the cost of money, while it's increased a little bit, if you look at that green, red, and blue line, it's still very much below. And so we haven't seen the amount of run up in money that's going into the farm credit system to lend to agriculture. Again, we're still below 3% on 30-year money, below 2% on 15-year or 10-year money, below 1% on 5-year money. And again, on the operating money, you see that is very attractive in terms of what the farm credit is looking at. What I do next here is basically just take the farm credit cost of money and subtract off the T-bill. And so what this in some respects gives me is the relative riskiness of lending to the farm credit system through either their lending to cooperatives or lending to farmers and ranchers versus what the cost of funds are that the U.S. government borrows at. In terms of looking at that, 0% basically would say that the market views lending to farmers equally as risky as lending to the U.S. government. And if you look at that, certainly you see that the purple line there on 1-year money, essentially you're looking at a 0.4% difference. And so essentially, you're looking at farming being 0.4% more risky than the federal government, certainly in a very outstanding perspective. And even if you look at 10-year money, essentially you're looking at 0.8%. If you end up looking at the 30-year money, certainly you're looking at a 0.45 with regards to that. One of the big things is that when COVID came on, essentially there was a spike where essentially the market viewed farming to be more risky than it was previous COVID. And then since then it's decreased. And if you look at this, essentially the 30-year money is about as small as difference as we've seen since the 2010-2011 period. And essentially, if you look at the 1, 5, and 10-year money, basically it's been lower than it has been the entire period. And so at least from a money perspective, in terms of the cost of raising money that the Farm Credit experiences to lend to farmers, ranchers, and cooperatives, essentially the risk that the market perceives is a lot lower than it was just a year ago. And so from that perspective, I think part of it is because the run up in profitability in the sector certainly, I think, puts the borrowing in a pretty good place with regards to not seeing increased risk within the sector. The next thing we've looked at is this one's a little bit of shorter time period. It's kind of a 2-year period from basically March to where we are now, kind of looking at what's been going on with daily Treasury rates with regards to 5-year and 10-year money. Again, you had seen a run up there in terms of from the beginning of COVID, mid-July, both in U.S. borrowing in terms of 5 and 10-year money. But again, over the last 2 or 3 months, it's been fairly flat. The next thing here is what's going on from the weekly tips rate. These are the Treasury inflation protected securities. The easiest way to think about this is the real interest rate. This is the real cost of borrowing when you subtract that out. In terms of looking at this, you'll end up seeing that the 5-year money basically is at about negative 1.8%. And so basically, if you save or are buying 5-year 5-year bonds, essentially you're losing about 1.8% per year compared to inflation. In terms of if you look at the 10-year, again, you're looking at somewhere between a negative 0.5% and a negative 1%. Normally, you're probably going to see this real interest rate. Some of the research done globally is that you're going to see this rate, or should see this rate, in the 1.5% to 2% range. And so in some respects, basically what this means is borrowing from the government is not a good way to save, or saving for the U.S. government is not a good way to save. I think what this means for agriculture is that I think there's going to be money looking for alternative investments other than treasuries. And so that may end up being some of the land, in terms of that when you're looking at putting money in treasuries. And again, there's not a lot of people that probably do this at this point. But over the last period of time, if you're putting money into treasuries, you're going to lose to inflation by about 1% on 10-year money and 1.5% to 2%. And so I think you're going to see a lot of pressure to invest in other things. And I think if there's indications of inflation, we'll get to a little bit. Some of the hard assets, I think, are going to be places where people may end up looking to store money. And one of the hard assets certainly would be agriculture. And you go back and see that investing in farmland in Kansas since 1950 is going to earn you 1.75% year in, year out above inflation. That could end up being pretty attractive if individuals think inflation is going to increase. And what we've done here is we've just looked at these daily tips essentially for a shorter time period again. You do see, for example, that around the COVID panic in the first part of March last year, those things peaked up to about 0.5%. And then essentially we have decreased over time. The last thing we'll take a look at is inflation, and certainly a lot of concern there with regards to potential inflation. Here I have the 5-year and 10-year backed out inflation rate. And so this is basically looking at the difference between the tips rate and the nominal treasury rates to estimate where we are from inflation. When we ended up in the COVID panic in last March, essentially inflation rates dropped quite a bit in terms of the 5-year and 10-year expectations. In terms of the 5-year was down at 0.25%, the 10-year was maybe about 0.65%. You see that over that last year, in terms of essentially on 5-year money, you're now looking at an inflation rate of above 2.5% per year. And so essentially those bond markets are trading with an implied inflation rate over the 5-year period of about 2.6, 2.7. If you look at the 10-year money, so over the next 10 year, the market has bid in an inflation rate of about 2.5%. A couple things that are important to look here, and we'll actually kind of jump to the daily expectations, is you've actually seen an inverse in terms of the 10-year and 5-year inflation rates. Normally, for example, you will see the 5-year inflation rates be lower than the 10-year inflation rates. However, since the beginning of the year, essentially, we've seen an inversion there such that essentially individual or market investors are actually thinking that the 0 to 5 inflation rate is going to be higher than the 0 to 10 inflation rate. And so essentially right now the market is bidding in a higher inflation rate over the next 5 years than it would be over the 10-year period. And so certainly those expectations are there. And certainly you can see kind of the run up with regards to where those inflation expectations have been. And in some respects, if you look at this graph or if you look at the other graph, the inflation expectations are about as high as they've been over the 10-year period. And so maybe to summarize here, in terms of Treasury rates are starting to increase, except for the 1-year rates. Farm credit cost of money is increasing, except for the 1-year rates. Essentially, the perceived risk for agricultural lending is decreasing. And so essentially on 30-year money over the last year, we've almost decreased that spread by 0.8%. In terms of on 1, 5, and 10-year money, the spread is 0.3%, 0.4%, and 0.8%. And so I think the key thing there to realize is that lending is perceived as being very, very safe to agriculture right now. In terms of the market, does view agricultural lending to be very safe over the next 10 years in terms of looking at these numbers. Real interest rates are really historically low. And so in some respects, that's kind of pushing money other places than into treasuries. The last thing is that inflation expectations are increasing. Over the last year, 5-year average expected inflation rate increased from 0.7% to 2.69%. So we've increased that by about 2%. 10-year, basically same time, 1.1 to 2.47. And so we have had an increase, but on a basis, we've only increased that by about 1.4%. And so the thing is, there is that inversion between longer term inflation expectations and short-term inflation. And so the market is beginning to expect more short-term inflation. And so with that, that leads us to the end. I think we have some time maybe for questions, if there are questions in terms of, I did get a direct question from John kind of indicating with inflation and interest headed up, is this setting us up for a repeat of the 1980s? At this point, given where we are on the numerator side, I think we're probably in pretty good shape, not looking at right now for a 1980s crash. I think it is pretty important to indicate that the numerator side looks pretty good. Certainly, and these numbers will come out 2 weeks from now in the seminar where we kind of look at where net farm income for farmers were in 2020 and government program payments. I think that the key thing is that 21 and 22 probably see some profitability in the sector. If you remember in the 1980s, there just wasn't the profitability in the sector. If you took a look at Dan O'Brien's and Guy Allen's presentation on Monday, certainly those break-even cases look pretty good that Mark Wood put together in that summary. And so certainly I think interest rates and inflation are something to be concerned about. In terms of if you have longer term interest rates, financing assets, certainly I would probably look at locking in some of those interest rates for a longer period of time. And I think those are instruments that are a little bit more available now than they were in the 1980s. But while I do have caution with regards to inflation and interest rates where they're headed. I think the numerator's pretty good, and I think the opportunity to lock in interest rates for a longer period of time are maybe a little bit more favorable than we were in the 1980s. And so I don't see a precipitous drop in land values at this point in time. I think that will provide some caution with regards to how land values go from a high perspective. And so hopefully that helps, John, on your question. Do you want to take this one, Robin, or should I take the one with regards to increase in land sales to avoid some of the possible?
It must be to you because I can't see it.
Okay, this one I guess was a direct message. The question, sorry, do you see an increase in land sales as heirs want to avoid a possible capital gain tax? And is the capital gain tax a threat? In terms of and part of it is that you're in the process of seeing law made. In terms of the original proposal, I think it was more of a threat than what the current proposal is. In terms of they were going to put kind of a increase in terms of the capital gains that would be subject to the higher tax rate. Certainly, in terms of individuals that feel that capital gains rates are going to go up, may end up seeing this as an opportunity to essentially put more land on the market. And so in some respects, I think you're going to see more demand for the market, as Robin talked about. But in some respects, if that capital gains puts more supply on there, I think in some respects that will better equilibrate demand and supply such that we don't see maybe quite the run up in land values that we could. But it is an interesting question. And certainly those that have lots of land, they may see this as an opportunity to essentially get those capital gains now before capital gains are enacted. And so I think that's very important to watch, simply because it could affect the amount of land that you see on the market. And again, that may be driving one of the things for heirs to begin to look at selling it. The issue, though, is can they find a place to park that money, converting it from land into cash? Are there alternative investments that they can get into that are going to provide a return?
There was a question in the chat: is investment in land by foreign investors tracked? Not here in Kansas. I don't have any information on who is actually buying this ground. One of the questions I get a lot, just got the other day, as well as how much does hunting and recreational use affect our agricultural prices here in Kansas? And I don't have a way of quantifying that. We know it is influential. I hear a lot of times of at a land sale, we have outside investors from just outside the state bidding on hunting ground. So I can't answer that, Nancy. Alan, I don't know if you have any insight, but I do know we have more than just farmers bidding on our ground than we used to have about 10, 15 years ago.
USDA does a survey, ALEOS, and it's about every 5 to 10 years where they actually track that information. And so I would encourage you to go to the USDA site, and it's AELOS. ALEOS is the survey. If you have trouble finding it, let me know and I can kind of help you find it. But essentially that's going to be probably 3-4 years out of date, I think, is when they've done the last one, but they would have information there with regards to land investment by foreign investors. Other questions? I know there was one question with regards to hardtop access in terms of if you have land that's on a hardtop road, does that affect the value? That kind of came in ahead of time, and essentially there you're probably looking at a 2 to 5% premium on land that does have that hardtop access. There is some positive aspect to that, but it is rather small. And again, this is going to differentiate with regards to how close you are to urban areas. And so you do tend to see a little bit of a positive boost if you do have that hard top access to land. I'm trying to remember.
Yeah, one thing I'll say about that too, Alan, I get a question, what is non-irrigated ground going for in a county? And, what that piece of ground is worth is what someone is willing to pay for it. So when I get land sales data and look at it at the county level, even, there's a lot of variation in price per acre in 1 year. So when I'm calculating that average, look at the minimum and maximums in that book as well, and you'll get a feel for the variation that exists. And that's land quality, that's access to the equipment, how far you have to drive to get there, some of the amenities on the ground. So it's really hard to quantify what one amenity actually adds to that value. So
Louise has a question with regards to nitrogen prices, and certainly we've seen a big run up with regards to nitrogen prices. Hopefully everybody purchased their nitrogen before the switch of the year. This year, in terms of there going to be a lot of variation depending on when nitrogen was produced, given the run up in that input. But again, what that's going to do is essentially going to take some of the profitability out of farming. And so with the higher prices, certainly, that's going to be pretty kind of a down driver in terms of the prices. And so while you do see the higher prices, the cost structure for farmers is definitely increasing, and you're going to see a bigger run up. Again, putting a plug in for 2 weeks, Greg Eibendahl is going to take a look at 2021 and 2022 income, where he will put in some of those run up in input prices that we've seen, and take a look at where we are from a price perspective, where we are from an input price perspective, and see where we are from a net income. But certainly higher nitrogen prices and other costs that have increased are basically taking some of that profitability. And so when you just look at the prices, it probably is presenting more of an optimistic picture than what farmers are actually experiencing on the ground.
One question here, are the sizes of farm businesses and ownership stable? And I don't have those numbers offhand, but if you look at the 2017 census compared to the 2012 census of ag, we're still getting bigger and bigger farms and an aging demographic of our farm owners. So we're going to have a lot of land turning over in the coming years, but that's a trend not just here in Kansas, but all across the nation.
We'll let you take the next one, Robin. Is there a place we look at for all of the land sales in a particular county?
So I can't actually disclose individual sale information for a particular county. That's why you see in the book an average and a minimum and a maximum. That's just under our agreement, something I can't do.
In terms of with wind and mineral rights selling separately from surface, do you think property tax will get split out to each owner? Typically, in terms of at least the agricultural land, and we'll discuss this next week, is basically just looking at the agricultural rights. And so I don't know that wind and mineral rights are going to be separately split out. I think basically the property tax on agricultural land is just measuring the value of property from a agricultural use. And so wind and mineral rights, I don't believe are taxed separately. Somebody can correct me if I'm wrong on that. But I do know that the agricultural use value, whether or not they own mineral rights or wind rights, does not get adjusted if you own it.
We have time for a couple more questions here. John has an interesting one with the increases in grain prices. What is the correlation between the grain price and the cropland price over time? And I guess I would say I don't know. That would be something interesting to look at. I'm guessing they're going to track up similarly with a little bit of lag, but as we've seen commodity prices come down, we just did not see the land prices come down like commodity prices did.
There is some work that we've done at there, and certainly there is a positive correlation, John. We'll send you an article in terms of where we actually did this in Kansas, kind of looking at instead of just the grain prices alone, we looked at kind of a profitability and looked at that on land price. And there is a positive correlation. It is slow to adjust. But we can actually send you a research paper that's probably 3-4 years old. And so I can look that up. The other thing is, I think Rich put in the window the alios information and where you can get that. In that. Thanks, Louise, on that. It is tax separate if it's severed from the land rights. But it is, if it isn't severed from the land rights, and I assume that you would have to have income from that, Louise, to essentially have it. And so if there's the potential for minerals and potential for wind, but it isn't being exploited, it would not be taxed until it was exploited. And so certainly if it is active mineral production or active wind production, they'll be taxed separately, but until that's developed, there would be no taxes, property taxes. It would be taxes agricultural land. But thanks for that help, Louise. Any other questions? Again, we appreciate you jumping on. Next week, we'll be looking at kind of tax valuation, use value. Again, use value and market value on land valuation is very different. And to kind of put some plugs in, all the government program payments that affect market land values do not affect use values. And so we'll kind of get into that next time. And then 2 weeks from today, we'll kind of take a look at where 2020 ended up from a net farm income perspective in Kansas. You should see that information coming out towards the end of the week. And then we will have Greg Eibendahl kind of look at where we're looking at from 21 and 22 based on the information now that could change drastically with regards to where we come to fall. And that's one of the things where we are at right now is that the markets are very unstable. People are just trying to figure out what the future holds and whether or not it's inflation, interest rates, land prices, commodity prices. Everything's very uncertain in terms of market participants are kind of walking on eggshells. But again, we appreciate you logging on. Do you have any final words, Robin?
I don't. Thank you everyone for being on. If you have questions, feel free to email one of us, but we will hopefully see you again next week.
All right. Thanks, Robin and Alan. Thanks, everybody, and we'll catch you next week.